What is up, everyone? It is the Dividend Grinder coming at you with the top 10 things to look for before buying a dividend stock. I am calling it the beginner's Bible to buying dividend stocks. Let's not delay. Let's get right into it. To do this list, we are going to be looking at Apple, and we are going to be on Yahoo Finance, where you can find a majority of these dividend stock tips. So we go down, and the first thing that we're going to be looking for, if we go and review more data, is forward PE ratio, or forward price per earnings ratio. A lot of people get caught with the normal trailing price per earnings ratio, but the forward price per earnings ratio, I believe, is a lot more important. This gives you a good estimate as to whether analysts believe that the company is going to be more profitable or just as profitable in the future, or if they believe that the company is actually going to get less profitable, in which case I advise you to stay away, as they are going to have revenue or income issues. At number 2, does the stock have a reasonable yield? We go up to Apple and we go to the basic stocks. They have a yield of 1.61%, very reasonable. Anytime you're talking blue chip, good quality dividend stocks, you don't want to go any higher than 5%. There are exceptions. You can be talking about REITs and MLPs and certain other ETFs, but generally speaking, anytime you get a dividend yield above 5% on a high quality stock, you might need to reconsider. It might be a little bit unreasonable, and we'll go into the list down below as to why they might be. So the third thing that I look for is the enterprise value, and a lot of people look at this, but I believe it is a good tell to see whether the market, the stock is overpriced or not, despite what the price per earnings ratio is. So right here you see the enterprise value, and then you see the market cap. If the market cap ever exceeds the enterprise value, it means that the stock shareholders are essentially overvaluing the company. They are actually making the company worth more than what it actually is, and what it actually is estimated by that enterprise value. So enterprise value should always be higher than market cap. They're always going to be close on the higher end stocks, but the enterprise value should always be more. The fourth thing, and one of the most important things that you need to look for, is payout ratio. And payout ratio can be found at the bottom of Yahoo Finance. You see payout ratio 25%. What does this mean? Well, it means that 25% of their earnings are being used to pay out the dividends to the shareholders, an excellent ratio. Any payout ratios between 0 and 50 are very, very good and very sustainable. 50 to 70 are okay, could use work, but they're not bad. Anytime you get above 70, and especially when you get into the hundreds and 200s, you're talking a stock that is not very healthy financially and should not be paying out dividends as high as they are. Payout ratio should be as low as possible, and it's one of the things that you should absolutely look for before buying any dividend stock. At number 5, we go to the dividend history, and this one we're actually going to go over to NASDAQ.com. We go over to NASDAQ.com. Here is the history of dividend payouts for Apple. This is the trend that you want to go. You want to see it go up. You never ever want to see these go down. It's okay if they stagnate for a long time, but if the second they start going down, that means that they could have a downward trend going, and the dividend yield just goes lower and lower, and the dividend payouts go lower and lower. That's a sign that the company cannot afford the dividends, or they're trying to restructure, or something major is going on. Please be sure to pay attention to the company's dividend history before buying any dividend stock. The next thing that we're going to look at, number 6, is the cash to total debt ratio. So companies are going to pick up a lot of debt on their balance sheet. So here's the total debt for Apple, $122 billion. That is a ridiculous amount of debt. However, they have a huge lump sum of cash waiting to pay a lot of it off, or to help pay for the shareholder dividends. $77 billion. It's okay if a company has a lot of debt as long as they have a lot of cash on hand, and it's vice versa. If the company does not hold a lot of cash, you better make sure that the total debt is also very low. If you see a company that has very low cash and very high debt, they're in trouble. The payout ratio is probably higher in that situation, and they could be looking at a dividend cut in the near future. At number 7, we're looking at operating cash flows. So going along with the cash, you want to make sure that they have operating cash flow. You want to make sure that's positive. You want to make sure that they actually have cash coming into the company, and that TTM simply means trailing 12 months. So for the past year, essentially, they've had $64 billion in cash go through the company. Some companies, such as Tesla, they do not even have a positive cash flow. This is something that you want to look out for. Even though Tesla's not a dividend stock, there are plenty of dividend stocks that do not have a good positive operating cash flow. You want to make sure that this number is positive, and you want to make sure it's as high as you can possibly get when researching against competing stocks that you might look to buy. At number 8, we want to look at consistent revenues. So revenues are always important to any company. It doesn't matter what type of stock you are talking about. You want to make sure that revenues are consistent. You're looking at Apple from 2015 to 2017. Very consistent. If you start seeing a downward stroke, you better get a little bit worried, and you better make sure that the profits are high to make up for that lack of revenue growth. If you see it growing, that's even better. You mean that the company is growing. There's plenty of money coming into the company. That's always a good thing. At number 9, will the stock be around for another 10 years? This is something that you have to consider. Will the stock be around for another 50 years? Is even better. When you're buying dividend stocks, you are buying long term. Can you imagine Apple being around for the next 10, 20, 50, 100 years? If you're looking at their financials, $220 billion in revenue last year, you can tell that this is a company that's going to be around for a while. You have to make sure it's not outdated, and Apple is not going anywhere. They're in the tech field. They're in cell phones. They're all over the place. Apple is all over the world. They are not going anywhere. You have to make sure the company you are investing in is going to be around for a long time. That's the whole point of a dividend stock, is you're doing it for the long run. And finally, at number 10, can the dividends get reinvested? This is a huge mistake that I have made in the past. I have bought monthly dividend paying stocks that did not have dividend reinvestment options available to them. So you're eventually taking small lumps of cash, and you can't do anything with it unless you have a massive quantity shares of stock. Go through your brokerage, make sure that the company you are about to buy does have a dividend reinvestment program available to that company. Guys, this has been the top 10 things that I look for before buying a dividend stock, the beginner's Bible. I make sure I go through every step, through every company. I do every fundamental analysis of the stocks that I do. I hope you enjoyed this list. Let me know down below if I've missed anything, or if you liked the video. Please let me know if you have any ideas for future videos. This has been the Dividend Grinder. Subscribe for daily investing videos. I will see you tomorrow.